In the dynamic world of the stock market, understanding the true worth of a company is paramount. This is where intrinsic value comes into play. Intrinsic value represents the inherent worth of a company, independent of its current market price. Think of it like buying a house. The market price might be influenced by factors like location and current demand. However, the intrinsic value lies in the house's structure, size, and long-term potential. Similarly, a company's intrinsic value is determined by its financial health, profitability, and future growth prospects. By grasping this concept, investors can make more informed decisions, avoiding the pitfalls of market volatility and speculation. Imagine having a superpower, the ability to see beyond the surface and understand the true potential of any company. That's the power of intrinsic value analysis. By delving into a company's financial statements, we can assess its earnings, cash flow, and assets. We can analyze its management team, competitive landscape, and industry trends. This in-depth analysis helps us estimate the intrinsic value of a company, providing a benchmark for investment decisions. If the market price is lower than our estimated intrinsic value, it might signal an undervalued opportunity. Conversely, if the market price is significantly higher, it could indicate an overvalued stock, one where caution is advised. Intrinsic value acts as our compass, guiding us through the complexities of the stock market. Imagine you're holding a rare antique. Its value isn't determined by the price tag someone randomly sticks on it. Its true worth, its intrinsic value, lies in its history, craftsmanship, and rarity. Similarly, a company's intrinsic value goes beyond the fluctuating numbers on a stock ticker. It's about understanding the company's core, its ability to generate profits, and its potential for future growth. This inherent value stems from a company's financial fundamentals. It's about analyzing its revenue streams, scrutinizing its balance sheet, and evaluating its management team. By understanding a company's intrinsic value, investors can make informed decisions that weather market storms. Think of a bustling marketplace. Prices fluctuate based on supply and demand, news headlines, and even rumors. This is the essence of market value, the price at which a stock is currently trading. Intrinsic value, however, operates on a different plane. It's about cutting through the market noise and assessing a company's true worth based on its fundamentals. It's about separating speculation from reality. While market value can be influenced by short-term sentiment, intrinsic value remains anchored to a company's long-term potential. It's the compass guiding value investors seeking sustainable returns. The difference between these two values is where investment opportunities emerge. When market value dips below intrinsic value, it presents a chance to buy a potentially undervalued asset. Determining intrinsic value is an art and a science. It requires meticulous analysis, a deep understanding of financial statements, and a dose of calculated judgment. Investors use various methods to estimate intrinsic value, each with its own strengths and limitations. These methods, such as discounted cash flow (DCF) analysis, delve into a company's future earnings potential. Other methods, like the dividend discount model (DDM), focus on a company's ability to pay dividends over time. This quest for true worth requires patience and discipline. Imagine a time machine, allowing you to peer into a company's future and witness its financial performance. The discounted cash flow (DCF) method attempts to do just that, albeit with spreadsheets instead of time travel. This method rests on a fundamental principle: money today is worth more than the same amount in the future. This is due to inflation, opportunity cost, and the inherent risk of the unknown. DCF analysis estimates the present value of a company's future cash flows, bringing those future earnings into today's terms. It's like calculating how much you'd pay today for a stream of income that won't start flowing until tomorrow. This involves forecasting future cash flows, a complex task that requires analyzing industry trends, competition, and a company's own financial projections. These future cash flows are then discounted back to the present using a discount rate. For investors seeking a steady stream of income, dividends hold a particular allure. The dividend discount model, DDM, focuses on just that, valuing a company based on its expected future dividend payments. This method assumes that a company's value is intrinsically tied to its ability to pay dividends over time. It's particularly well suited for mature, stable companies with a consistent history of dividend payments. The DDM calculates the present value of all future dividend payments, factoring in the expected growth rate of those dividends. This requires estimating both the next dividend payment and the long-term dividend growth rate. The discount rate, similar to DCF, reflects the investor's required rate of return. A higher discount rate lowers the present value of future dividends, reflecting the time value of money. In the fast-paced world of investing, sometimes a quick snapshot of value is needed. The price-to-earnings (PE) ratio provides just that, offering a glimpse into how much investors are willing to pay for each dollar of a company's earnings. This widely used metric compares a company's current stock price to its earnings per share (EPS). A high PE ratio suggests investors are optimistic about future growth, while a low PE ratio might indicate undervaluation. However, the PE ratio should be interpreted with caution. It doesn't account for differences in capital structure, growth rates, or risk profiles across companies. Moreover, it relies on accounting earnings, which can be manipulated or influenced by one-time events. Therefore, the PE ratio is best used as a starting point for further analysis, not a definitive measure of value. Imagine a treasure chest filled with gold, jewels, and other valuable assets. The net asset value (NAV) method unlocks value hidden in a company's balance sheet. It's relevant for asset-heavy companies like real estate, holding, or natural resource firms. NAV calculates net worth by subtracting liabilities from assets. It measures liquidation value, the amount left after selling assets and paying debts. However, NAV has limitations. It doesn't account for intangible assets like brand value or intellectual property. In the world of technology, few companies command the brand recognition and customer loyalty of Apple Inc. From its sleek iPhones to its innovative Mac computers, Apple has become synonymous with quality and design. But beyond the allure of its products, Apple's intrinsic value lies in its robust financial performance, its loyal customer base, and its ability to generate significant free cash flow. Apple's diversified business model, encompassing hardware, software, and services, creates multiple revenue streams, making its earnings less susceptible to fluctuations in any single market. This diversification enhances its intrinsic value by providing a buffer against economic downturns. Moreover, Apple's ecosystem of products and services creates a powerful network effect. This loyal customer base further solidifies Apple's intrinsic value. From its early days as a software giant, Microsoft Corporation has transformed itself into a cloud computing powerhouse. Its Azure platform has become a cornerstone of the digital economy, powering businesses worldwide. Microsoft's intrinsic value is rooted in its recurring revenue model, driven by subscription-based services like Azure, Microsoft 365, and LinkedIn. These services provide a predictable and growing stream of cash flow, a key driver of intrinsic value. Furthermore, Microsoft's diversification across software, cloud computing, and gaming creates a wide economic moat, protecting its market share and profitability. This diversified portfolio enhances its intrinsic value by mitigating risks associated with any single business segment. Microsoft's strong financial health, characterized by a solid balance sheet and low debt levels, further bolsters its intrinsic value. This financial strength allows the company to invest in future growth opportunities while also returning value to shareholders through dividends and share buybacks. Both Apple and Microsoft exemplify companies with strong intrinsic value, driven by a combination of factors that set them apart in the marketplace. Both companies boast strong financials, consistently generating substantial free cash flow. This cash flow provides the fuel for innovation, expansion, and shareholder returns, further enhancing their intrinsic value. Moreover, both companies enjoy wide economic moats, protecting their market share and profitability from competitors. Apple's brand loyalty and ecosystem create a formidable barrier to entry, while Microsoft's dominance in cloud computing and software provides a significant competitive advantage. These factors, combined with their growth potential and commitment to shareholder value, make Apple and Microsoft attractive investments for those seeking long-term growth and stability. Their intrinsic value serves as a testament to their enduring success and their ability to navigate the complexities of the ever-evolving tech landscape. In a world of market volatility, intrinsic value remains a beacon for long-term wealth. It's about looking beyond daily fluctuations and focusing on fundamental drivers. Apple and Microsoft exemplify how intrinsic value leads to sustained growth. Their stories highlight the importance of strong financials and competitive advantages. Embracing intrinsic value helps navigate the stock market with confidence. Imagine a lighthouse, its beam cutting through the fog and darkness, guiding ships safely to shore. In the turbulent sea of the stock market, intrinsic value serves as a beacon for investors. It provides direction, assessing opportunities based on a company's true worth. Understanding intrinsic value helps investors make informed decisions, minimizing risk. It helps identify undervalued or overvalued stocks. When a stock's price dips below intrinsic value, it signals a buying opportunity. Conversely, if a stock's price soars above intrinsic value, it warns of overvaluation. Think of intrinsic value as a compass, guiding investors through the complexities of the stock market. It helps them stay the course, focusing on the long-term fundamentals that drive sustainable growth and profitability. By understanding a company's intrinsic value, investors can develop a disciplined investment strategy, one that prioritizes value over speculation and emphasizes patience over short-term gains. Intrinsic value is particularly valuable for long-term investors who are less concerned with short-term market fluctuations and more focused on identifying companies with the potential to deliver consistent returns over time. By investing in companies trading below their intrinsic value, these investors aim to capitalize on the market's eventual recognition of that value. While intrinsic value provides a powerful framework for evaluating investments, it's essential to acknowledge its inherent limitations. Estimating intrinsic value is not an exact science. It involves making assumptions about the future, which is inherently uncertain. Think of trying to predict the weather weeks in advance. While meteorologists use sophisticated models and data analysis, unexpected variables can always arise, leading to inaccurate forecasts. Similarly, estimating a company's future cash flows, growth rates, and discount rates involves a degree of subjectivity. Different analysts may use different assumptions, leading to a range of intrinsic value estimates, even for the same company. Despite these challenges, intrinsic value remains an invaluable tool for investors. The key is to acknowledge its limitations and embrace the uncertainty inherent in financial markets. Rather than seeking a precise intrinsic value number, investors should focus on understanding the key drivers of a company's value and assessing the range of potential outcomes. This involves conducting sensitivity analyses, testing how different assumptions impact the intrinsic value estimate. Moreover, investors should view intrinsic value as a dynamic concept, one that evolves as new information becomes available. By acknowledging the limitations of intrinsic value and embracing the uncertainty of the markets, investors can use this powerful tool effectively, making more informed decisions and navigating the complexities of the stock market with greater confidence. In the ever-shifting landscape of the stock market, intrinsic value stands as a steadfast compass, guiding investors towards rational decision-making. While determining intrinsic value is challenging, it provides a framework for assessing a company's true worth. By understanding financial statements and competitive advantages, investors can see if a stock is overvalued or undervalued. This empowers informed choices and long-term growth.